waste anybody's time or that we're respectful of maybe your lunch hour that you're on. My name is John Anderson. I'm the chapter chair for SCORE Central Maine, and we are hosting this webinar with Echo Palmer of Echo Palmer Accounting LLC. Going to be talking about small business taxes. One thing I'd like to say too is a special thanks, Katie Palmer from the Lewiston Auburn Metro Chamber. Katie, it's so great to always have your support and your help and your partnership as we put on these free webinars to help our business community. Thank you very much. And also the Kennebec Valley Chamber up in Augusta. Want to thank them for hosting this webinar as well. And just so you know, too, is that SCORE is a resource partner of the Small Business Administration, and we help clients at all stages of the business cycle from pre-start to exit. And we look forward to responding to your questions as they arise. And when you do have a question, please, you can post it in the Q&A panel. That's easier for me to track because that way that forces me to answer and account for it, and I won't miss anything. So please post it in the Q&A panel. And we also want to make sure that if we do, we're going to try enabling everyone, of our participants to go ahead and speak. And we would ask that you would mute your microphone at any time when you are not speaking there too. And we'll just keep track of that too. So why don't I go ahead, Echo, why don't we go ahead and introduce you, and I will pull it right up to the slide deck right here.
Great. So, good morning or good afternoon, everyone. Thank you for joining. Just a brief bio on me. I own my own firm in Augusta, Maine. This is my fifth firm, and I've been doing this for over 20 years. So the benefit of that is I've seen a lot of different firms and how they, handle taxes for their small businesses, and I see a lot of consistencies there, which kind of gives me the confidence to share with you, some tax advice or just some general small business knowledge as you start or continue your small business. So just my basically what we're going to discuss today in my you'll see in my table of contents is just setup of your business's tax reporting, expenses, and other items, and it's really driven by my interactions with clients, their questions, the holes in their knowledge. It's kind of, I think, beneficial to others just based on my experience in dealing with many different types of businesses. In my area, there's a ton of construction businesses, so I feel like that's kind of who I deal with often, but all industries. I've worked with many industries in the small business realm. So the first thing I want to talk about is formation or types. This comes up a lot, and what I usually, how businesses usually start is sole proprietorship. We've all seen this. There's not really anything you need to do to organize for tax reporting reasons. You get a DBA or doing business as from your town office, city office, and designate your business name. and you'll see under sole proprietorship, it's called, it is an often unknown thing, qualified joint venture. That is between spouses, non-LLC business entity type, where, you know, it's owned often 50-50 by each spouse. And there's reasons why that makes sense for tax reporting. A lot of it has to do with if that's your only endeavor, or your small business is your only income, it's a way for, you know, self-employment tax to be split between two persons. In other words, self-employment tax meaning funding their social security, Medicare. And so that's why that often makes sense. And it often makes sense because both spouses, that is their main job. I'm gonna skip down to LLCs because that's often what sole proprietorships evolve to. And it's a designation formed in your state through the Secretary of State's office. And it's, you know, you can read the label, limited liability company. You know, it basically separates you from your business when it comes to liability. And, you know, I always advise people to, as they grow, seek out a business lawyer to really understand the ins and outs of that. It's not really an accounting or tax function. And the reason I skipped down to limited liability or LLCs is because this is a state-formed entity. So in other words, the federal government or the IRS doesn't really recognize it in a way. In other words, if you're an LLC, you can report as either a sole proprietorship, it still goes on your personal return, your income and expenses. You could be a partnership if there's partners involved, or you can elect to file as an S corporation, which is very popular. I don't know, entity type, and most small business owners, if they've had any time in it, understand that's where they should be headed. And it's because of tax savings, right? So that's why that's an attractive entity type. You know, with all of these different ways of filing and these different formations, you know, with partnerships, you should have an agreement. You know, you should really seek some legal advice. You know, S corporations, just you have to have bylaws, you know, so you have to kind of go into this, any changes informed. C corps are, or corporations, are usually for much larger businesses with many shareholders. S corporations are limited to 100 shareholders, which, you know, that's a lot, but C corps, there's no limit there. Double taxation, I know we've all heard that. What that really means is your corporation's taxed on its income at a corporate level, but then the shareholders are also taxed on their dividend distributions. S corps work very differently in tax, where it's a pass-through, just like a partnership, where that income, actually, you're not paying any taxes at the S corp or partnership level. That flows through to your personal return on a, you know, via a K-1 form, and and your distributions generally aren't taxable. I mean, there are, you know, if your distributions exceed your basis in the company, which I won't go into, then that could be you could be subject to capital gains tax. But, you know, generally, if it's not, you don't need to be concerned about tax on your distributions under normal circumstances. And just to touch on nonprofits, that's a IRS designation. You apply with the IRS to get, you know, a 501(c) or different nonprofit types for your, you know, charitable endeavor, or, you know, HOA or whatever nonprofit entity you may have. So that's very general, but that's hopefully gives you some ideas. Now, just to touch on S corps, the downside, what I like to tell people is, you know, you got to have a payroll service. You got to pay for 2 tax returns. You've got to have good books. you've got to keep your banking very separately, which you should with an LLC anyway. But it's more of a less flexibility there than with just a sole proprietorship, where it does allow you to be more flexible. So it's a decision, and you should, like I said, be informed before you take that leap and understand the complications of being an S corp as opposed to um, just a sole prop or just an LLC filing as a sole prop. So next I'm going to briefly touch on form due dates, and most of the discussion is just know your due dates. There's different due dates, we all know April 15th for our personal returns. Partnership and S corp returns are due a month before, which kind of makes sense because you need those returns done prior to your personal return, because that information has to go on your personal return, or else you need to amend. And I've seen people new to this. "Oh, I filed my personal return," and I'm like, well, we're going to amend that because there's an order of operations here. And there's, of course, payroll deadlines, sales tax deadlines, etc. Often there's thresholds involved in how often you have to report these things. In other words, you have so many taxable, you pay so much sales tax in a quarter, they might move you to monthly. Payroll, similarly, you might have to pay your payroll taxes every time within 7 days of your wages being paid. So in 1099s, those were for NECs, non-employee compensation. That due date was just last week. And that means your records need to be in order to meet these deadlines. Other 1099s like you get from your investment companies, they have more time. That's why often you won't get them till February, because they are allowed that time. So with extensions, both your business returns and your personal returns can go on extension 6 months. That lands the business returns in September generally, and your personal return October 15. Fiscal years is something that, it's a non-calendar year. In other words, you can elect to file a fiscal year return. It's often nonprofits do it. They end their year according to when grants come in, or some businesses according to when their most of their income hits. So it's an option, but again, it's something you'd have to be informed about, and if that works for you, and if it makes sense. It's easier to have a calendar year just based on your individual returns. There's no flexibility there. They're due. And extensions are not a extension to pay. They're an extension to, you can put off your filing, but you can't, it's not an extension to pay. In other words, you estimate what you think you're going to owe, you get as close as you can, and you pay that on time. Otherwise, there's going to be penalties or interest attributed to that. So moving on to business expenses. There's a lot of business expenses, and I'm just picking on the expenses that I see the most confusion on, and I have to give the most advice on, and it's not always loved advice. It's not always taken well, because everybody has a friend who does it this way or that. Startup expenses, that's for, if you have the type of business that really takes a lot of funds to start up, and before you start generating a profit, you have to know there's some limits there and what you can expense in its first year or years. You're limited there. So just to give you a ballpark, your startup costs that you can expense can't really exceed $10,000. Organizational costs can't exceed $5,000, or else they have to be amortized over a period. So in other words, it's not going to be correct to say take a $60,000 loss in your first year. Just know that's going to need some scrutiny, and it should be looked at. Meals and entertainment, this is a popular one to people go a little crazy on. I say back to 50% because after the COVID years, it was at 100% for a while to kind of support our restaurant industries, I'll assume. It's back to 50 for 2023 and beyond. There's exceptions for like DOT, like truck drivers, they can take 80. There's exceptions to almost every rule with the IRS, but that's know what a business meal is, know what is allowable, not your everyday lunch, not your coffee. Um, in all fairness, it wouldn't be fair to wage earners if you could just expense all of the meals, all of the things. Entertainment, business entertainment, that's no longer expensible. It was in 18, it changed. You can't take your client out to golf or a concert or fun stuff and expense it. It's just not allowed. If you have a meal, they're on the golf course or next to the golf course, that's allowed. So just know that that's because I get that question often, can I go to a baseball game? No. You used to be able to, so the confusion is understood. Uniforms, I get a lot of this on P&Ls where, it's really attire that's not suitable for everyday wear, right? Of course, if, you know, people feel like they can justify it for all the reasons, but if it has a logo on it, it's a uniform. If it's safety gear, glasses, boots, something you're not going to wear around town, that's a necessary business expense. So just, logoed stuff is definitely allowable, but I see people trying, they need jeans for work. It's not how that works. Business gifts, I see this a lot also. It's very limited. It's $25 per person. So, you can't, I see people not really understand this. Oh, I gave a gift to my client. Well, you can't give them much and have it benefit you. Unfortunately, that's just a very limited expense. Auto expense is probably one of the more confusing topics for folks. And, the IRS does scrutinize auto expense. So you really have to understand how your auto is being used, when it comes to S corporation, who owns the auto. There's specific rules around this, but I'll tell you, a good start is to track your mileage, no matter what you're doing. It's good practice, and in my opinion, necessary practice to track your business miles, specifically because normally, especially with a small business, this is a shared vehicle. This, you use it for personal use also. Of course, there's exceptions with company vans and stuff, or trucks, but, really, if that's your only vehicle, it's going to be understood that it's used for both. And it's a checkbox on your tax return. Is this available? Does the owner have another vehicle to use? It's a question. So it's looked at. So I think that's always a good start. Track your mileage. You can take the IRS auto deduction is for sole props. This S Corp's different, but you have the option between mileage deduction or actual expenses, gas, insurance, etc. So it's an either or scenario. With mileage, you can't, as people say, write off your vehicle or depreciate your vehicle. That's baked into the mileage rate. You have to take actual expenses. So you just have to kind of understand how that works, and your tax practitioner should be able to tell you which one in a given year benefits you more. And you can't always fluctuate between them on a vehicle. So I just, not to go into detail, but just you should understand that. And with the mileage rate being 67 cents per mile, this is a generous deduction that can be, rather large for businesses that have a lot of travel involved, a lot of contractors specifically. I don't have, I mean, I have an accounting firm. I can't count my mileage from my home to my office. That doesn't, count. I could theoretically count the mileage from my office to a client, but for me, that doesn't happen often enough to make it worthwhile or something I would track. So, with S corporations, it's very different. This is a corporation, it's in the name. So it's very, there's different rules and different compliance. S corporations can only take actual expenses. If you personally own the vehicle, but use it for your S corporation, your S corp is supposed to reimburse you for the use. You're not supposed to just, act like it's a business vehicle. There's rules around surrounding it that you should know. And again, it's a lot to talk about, so it's something that you'd want to talk to your tax person or accountant about. And then there's always personal use of a business auto. That is also a thing where the S corp owns it and you use it personally. Well, that's a calculation. That personal use is supposed to be added to your wages. And then you reimburse the company for the FICA, half the FICA, which is the Social Security, Medicare. So these are, you should be knowledgeable about these business vehicle use or personal use for business, because again, it's something the IRS, I know, has their eye on, and it matters. And you got to have good records there. The better the records, the better for you in the event it was ever looked at or scrutinized. Home office, this is a fantastic deduction for small business. Small businesses, there's the good and the bad. The bad is it can be a difficult tax situation for planning and not, but the benefit of having small businesses, you get these type of deductions, and home offices can be a really valuable one, especially, I see for a contractor who uses his garage. So how does that work? You prorate the expenses that go into your home or running your home: mortgage interest, real estate taxes, utilities, repairs, etc. You prorate it by the square footage rule used for the business, divided by the total square footage. So if you use 25% of your home exclusively, that's an important word, for business, you get 25% of the deduction. In addition, you depreciate your home. You can depreciate your home, that the business portion. I mean, it's not a huge deduction because it's over 39 years, but every little bit helps. So insurance is another important thing for S corp owners specific to understand. Shareholders' health has a really different type of treatment. Your company can pay your health insurance. However, again, that's supposed to be added back to your W-2, and then it's notated in box 14, and you get the healthcare deduction on your 1040. Officers' life and disability. Life insurance typically is not deductible on your business books. Disability, it depends. So you're just going to have to work with your practitioner to understand, or they will tell you what is allowable in terms of business expenses. And, there's, of course, differences of opinion, but the information's out there online for you to be empowered as well. And I always suggest, checking it out. So that's what I got for that. Now moving on to assets. Business assets and depreciation, I kind of referred to the writing off of your vehicle, you know, and other depreciation things. Now, assets that should be depreciated, assets, what's the point? You're trying to not take the whole expense, or you shouldn't be taking the whole expense for certain machinery, furniture, vehicles that have a useful life more than, a year. And is there a threshold for the amount? I'm gonna say yes, really, because there's you can elect, and I'm talking small businesses this whole time because there's different rules for different, but there's a threshold of $2,500. Basically, if your asset or your business purchase of machinery, like all these items I said, if it's less than $2,500, you can elect to just expense it in the year that it was purchased. So, generally, but that has to be consistent. So if you're treating your assets that way, treat your assets that way. Don't, you can't pick and choose. That's an election. That's to say to the IRS, this is how I'm this is the treatment for these assets. Depreciation life, every asset has its depreciable life designated to it. Your accountant knows it depends. Auto, just to generalize, autos 5 years, machinery, equipment 7 years, residential property 27 and a half years, commercial property 39 years. So basically spreading out the expense over its anticipated life cycle. It's not a perfect calculation, but it's what it is. Land improvements 15 years. So yeah, so that's what that is referring to. And accelerated depreciation is kind of the next topic. Section 179, that's the write-off tool people think about. That's limited with autos. It depends on the size of your automobile. It depends on, your machinery, typically, or equipment, you can just write it off. There's limits, but it's like up in past 2 million on how much you can do in a year. That limit's really for much larger businesses than I suspect we're talking about. Bonus depreciation, that's being phased out. That's another way to accelerate your depreciation, which can, by the way, can only happen in its first year of service. That's being phased out. It's going down. It went from 100 and now last year 80, this year 60. So they're phasing that out. Why it's not attractive is because Maine doesn't honor that accelerated depreciation type. In other words, it's an add back to Maine in terms of taxable income. And then why do I mention rental properties in 179? You can't, rental properties are more limited in what they can use 179 for. They can't, you can't use it for a washing machine. You like certain improvements, certain qualified leasehold improvements or qualified improvements, improvement property, I should say, it's allowable, but just know that rentals property, it's limited, different rules for you. Depletion just means it's kind of just to remind you, land doesn't depreciate generally. When I put a rental property on your tax return, I look at your assessment of your town or city and determine what percentage of what your cost is attributed to the land, what's attributed to the actual building, and we depreciate the building portion, and the land retains its cost basis. Depletion is the only time you see land depreciate in a way if you're, if it's a sand pit or, there's ore or there's, aggregate or whatever's, you bought that land to get these type of things, and it's reducing the value of that land. So it's a loaded subject, but it's not a choice. I've had to go back and amend rental property returns because they omitted the depreciation. You have to do it. You have to depreciate your rental properties and your assets. So um, that's what I got for depreciation. Um, so just to stay on task and try to get through, we're gonna move on to bookkeeping and accounting. I do a lot of it. It's probably the most, tax is also complex, but bookkeeping and accounting determines your tax result and your tax return. So cash versus accrual. Basically, accrual basis reporting is you recognize the income and expense when the invoice or bill is received, when you invoice somebody, that's when you recognize the income. When you receive a bill, that bill date determines your expense, when that expense was incurred. Cash basis is more about when did the income get into my bank? Like that's when I recognize it. When did the expense get paid out? That's when I recognize it. Generally, small businesses are cash basis, but you can do either. You can't flip flop. If you want to change what type of accounting you're doing with the IRS, there's a form. You got to fill out 3115. So just know, often people don't know the difference, and their accounting software often defaults to accrual-based reporting. So you have to make sure you're reporting your P&L is spitting out your method of accounting reports. So just be aware of that. Assets versus inventory, kind of obvious, but assets belong to the company. Inventory is, items that you're gonna resell, purchases like that are not being kept by the company, but sometimes that gets a little confused by people, so worth mentioning. Inventory and cost of goods. So for businesses who, deal with reselling or building components and selling, who hold an inventory, you got to do that inventory count at least annually, so that because it affects your cost of goods, so take your, do your counts. Your accountant's going to ask for it. As your inventory is calculated on your return, it's basically it'll affect your cost of goods sold. In other words, it'll affect your profit. But it's important for certain businesses to understand inventory types and what, in tracking and how that affects their bottom line. Rental property accounting, where I see the most errors are with people with multiple rentals and people with shared rentals. In other words, they live in part of the duplex. They live in half the duplex. The other half is rented. The important part of tracking rental properties is expenses and income have to be tracked by property. It's not a lumped in thing. You own 3 properties. Those are 3 rental schedules. Okay. And if you own a duplex, half of the shared expenses are expensed, right? Maybe not obviously, but your portion or your half of the real estate taxes, those don't matter. Those don't go on your rental schedule. So it's, if you just take your, in that case, expenses and divide by 50, of course, there'll be repairs and expenses associated with the rental unit. That's accounted for. And, not to go into rentals, but rental income is treated differently than other incomes. It can be suspended. So just understand there's some differences there as well. Accounting software, bookkeeping processes. I always suggest, even if you go find a free tool online or do QuickBooks, which seems to be the standard for small businesses now, it's important. Everybody I've experienced, if you don't have a good software, you miss things. It's worth the investment. It's worth either hiring a bookkeeper or understanding bookkeeping. And if you're an S corp, you gotta have it. You gotta, you have to track your basis in the company. You have to have a balance sheet, in my opinion. So I see this step missed a lot. But in this day and age, I can't imagine not having it. So it should be kind of day one stuff, in my opinion. Separation of business and personal banking, I see this offense often. At some point, you know, if you don't separate these things and you're an LLC or an S corp, you know, if it's ever looked at and they can't distinguish you from your business, they might not distinguish you from your business. So that's kind of where I'm going to leave that. And if you're paying a bookkeeper, if you're going to mix these banking, you're gonna pay double. You know, it's like, that's how I would look at it. So what's on your balance sheet? Why does it matter? Most people look at their profit and loss, they don't look at their balance sheet. I find a lot of expenses on your balance sheet by accident. That's one obvious reason. Your inventory valuation is on there, or your inventory cost is on there, I should say. Your loan balances are on there, they should be accurate. Your equity in your own business is on there, your draw, your distributions from the business in any given year. I mean, this is an important, you know, you got to look at both reports or have somebody looking at both reports to understand the operations or the income of your business, or else many things will get missed. So I'm always a little bit over, but employees and payroll, I'm going to wrap this into my segment after it, which is retirement, because this is becoming a hot topic because of the mandate. And, you know, if you have 5 or more employees, you're going to really have to pay attention to what you need to do with your employees. You know, 10, there's thresholds, 10 or more, you know, PTO, you know, FMLA at a certain point, I think it's 30, I don't remember. So you have to understand the HR portion, which I'm not an HR person, but there's some overlap there. So, you know, understand, like, a big mistake I see a lot is, as a partner in a partnership, you the partner cannot be on payroll. As a sole proprietor owner, you yourself cannot be on payroll. You can have payroll and employ people. As an S corp owner or shareholder, you need to be on payroll and pay yourself a reasonable wage. So understand your kind of obligations there. And I just like to mention to people, you know, payroll is an expense, but it's also for people who are, you know, have a hard time with tax planning and getting that big hit at the end of the year. Payroll, running yourself, you know, being an S corp and being able to tax plan through payroll, in other words, paying in as you go, because we are a pay as you go tax system, was really can help you bridge that gap between being self-employed and a wage earner. So just to briefly touch on contractors, which the next slide is, understand the rules. What is considered an employee? What is considered a contractor? It's very decisive. It's like very understood. So in other words, if the IRS, if you have somebody you're treating as a subcontractor, it doesn't really matter if it's looked at and they're designated as an employee, you're going to have to go back and pay some payroll taxes. So you want to understand, when you are using somebody as a sub and they're really might look more like an employee, that can really come back at you. Workers' comp, that's mandatory, not for the owner, but for your employees. In this state, you got to have it. If you do employ some subs, there's a couple forms, you know, standard forms. You want their W-9 so you can issue them a 1099 at the end of the year. They're very motivated to give you that if you make them, you know, wait for the check until that's received. COI, a certificate of insurance, so you know they're covered by comp, is also an important thing, or, you know, to protect you. So moving on to retirement. Retirement I'm bringing up because it's a great tool, right? Even if you're self-employed, you can and should have retirement. Why? So you have a retirement account and also deferring income. That will bring your tax down in the years that you're making the most money you'll ever make. And there's a lot of different options there. for, you can match your, you can do a 401k and you as the employer can match. You can do a SEP. These are high thresholds, but they all have very specific rules and limitations, and benefits, and it's specific to the individual. Of course, there's individual, we can move to the next slide, which I found from my friends at Advanta IRA. I don't know who they are, but they have a great little chart of some of the retirement and etc. options. Traditional IRA up to 7,000 a year. Catch up is always available to folks 50 or older. That's deductible. Roth IRA is more limited, so I see a lot of over contributions. It depends. There's thresholds, so don't assume you can maximize it necessarily if you're kind of a lower income. Not deductible. Most people know SEP IRA, huge, ability to save there, but it's limited. Also, so you can't just do the max. You have to know what the max is for you. 401k and simple is great for folks, small businesses with employees. HSAs, another great tool to, defer or not even defer. If as long as you're using it for medical, you're not paying tax on it. And there's, again, there's rules there, thresholds, so you'll have to know that as well. And if there's overlap, if you're doing a small business and are employed, that's a special scenario where you have to know what you're allowed to do if you're covered with an employer and you're trying to do something for yourself through your small business. And just to mention the mandate, I did put a link on, I think, yeah, I mean, you can Google it. I thought the best article I saw was in the Sun Journal, just basically outlining the mandate. You're going to start, if you're an established small business, you're going to see emails about this. Don't ignore them. Know what you have to do, because they're going to penalize folks. Again, 5 or more employees, 10 or more, there's different dates associated with when you have to start offering, or finding maybe you're exempt, but you have to know that and prove that. So I just want to mention that that's more of a HR thing, but I deal with payroll, so I just thought it was worth mentioning. So that's my presentation, and I'm open to questions, and hopefully you found some useful knowledge there.
All right, thank you very much, Echo. What I'd like to do is I'd like to just start working through our various Q&A. This is an hour presentation. I'm not going to stop it at an hour, but Echo, that's up to, you've got a full-time job here doing the good work that you're already doing. And anybody else wanted to, you'll just stay on as long as you'd like, or you may have to go ahead and get off. What we will do is that we will send you a recorded version of this webinar along with the slide deck. And that'll just give us a couple business days to get that together. But everybody who has registered and who is attending, we'll make sure that you get a copy, a recorded version of this webinar, so you won't miss a thing. All right, let's go ahead and Echo, I'd like to just start with our first one. And that's from Kelly Caron. What does 50% for business expenses mean? Do you mean you can only expense 50% of the valid expenses?
No, I think I just had that on meals. So meals, and sorry for the confusion, meals is limited to 50% of the meals. So in other words, if a company has $200 worth of business meals in the year, they can deduct 100.
Okay, great, thank you. And this one from an anonymous, a person who asking for a friend. Can you give a $100 gift and only expense 25 of it with a receipt?
Sure, absolutely. I would call the other portion a draw. It's kind of like a lot of people think GoFundMe's are charitable donations. They're not. You're literally doing this out of the kindness of your heart. It's not a deduction, it's an owner distribution.
Right. Okay, from Amy Smith, would a giveaway at a presentation be considered a business gift or an advertising and promotion expense?
Yeah, yes, and that's a good question. There are different, advertising and marketing, that's a different scenario. So different treatment, not the same kind of limitation, but something you'd want to kind of look into and be informed of.
I
Yeah.
see. And
Mhm,
that would be up to the person claiming this to determine the definition of that.
mhm.
Okay, great. From Kyle O'Neill, what if the business is in a detached garage? Would it be the same to calculate square footage and prorate?
Yes.
Okay,
Sometimes, they have their own utilities or like own electricity, so that's an easy calculation, obviously you wouldn't be utilizing utilities in the home if they were separated.
okay, great. Okay, Echo, from another asking for a friend, for an LLC, I was told I only need to file taxes annually. Is that right?
Yeah, so yes, there is, so I just want to differentiate income tax filing, yes, depending on how your LLC is designated. Again, there's different choices, but that's a once a year filing. There's also a annual report requirement. You have to file annually with the Secretary of State. Often your registered agent does that for you, whoever set it up for you, which could have been a lawyer or an accountant. So every year you got to pay a fee to keep that in good standing, your LLC active and in good standing.
Okay.
So not, a fee, but not a tax, but an annual requirement.
Are there quarterly taxes that have to be paid?
Mhm. Yeah, so it's specific to your scenario. So as a tax practitioner, basically, I have when you're supposed to estimate your tax due based on your what a good base would be your prior year's tax return, your estimated growth or change will generate during tax time, or that's when I do it, during when your taxes are prepared. That's why I always suggest small businesses to use a practitioner. They You have that conversation, they look at how you're trending or where your income landed, and they generate 4 quarters of estimate for the federal, for IRS, and for the state if that applies.
Okay, great. And from Joy L. Talbot, how does life and disability insurance work for a sole proprietor LLC? Could you point
Yeah.
us to recommended online resources to learn more?
There's none specific. I mean, the irs.gov is, kind of dry, but always my best source. It is similar, like generally you're not going to deduct life insurance, disability. Often you're not going to deduct the owner disability, but yes to the employees. So there are, the IRS is a good place to start. Your insurer is a good resource.
Right. And you're an independent insurance agent. That's one of the things that
Right.
we have a number of mentors who are familiar with that. And what we do is we refer them, go ahead and give them a call. It doesn't cost anything, and people are happy to answer questions. We also we have for Kelly Caron, for small LLCs, do you recommend free expense and mileage online tools like Zoho, or just to record it on a spreadsheet?
I think anytime you can do it in an electronic way, like a lot of these apps track the mileage. You don't even have to look at your odometer necessarily all the time. Like a lot of because they do it by GPS. So I say absolutely use one of those tools. I don't have one specific that I recommend. A lot of, if you have QuickBooks, there's a tool there in their app, so you can kind of have both things going on. But yeah, I definitely recommend electronic records of that.
Right. And I think I remember you saying at an earlier webinar that anything you can do to make it electronic or automate it like that, it ends up costing a little bit less in terms of
Mhm.
it's less work that somebody like you has to do for your client. as opposed to a shoebox full of receipts, I think was your
Yeah, yeah.
favorite.
Or, I've had to go through yellow page, and do calculations, starting odometer and ending, so not a good time, but
Okay, from asking for a friend, do local business equipment taxes apply to home businesses?
I haven't seen, I believe, no. I have an S corp, I do have small property taxes. Um, I don't know. I would check with my city or town. I don't, those things are kind of seem to happen automatic. I didn't, I didn't report anything. They're just like, we know you're there and what do you have? What's your equipment?
Okay. Okay, from Rebecca Dill. Does SCORE offer, or can you recommend another source, educational resources for bookkeeping specific to inventory-based businesses?
Inventory is tricky depending, I mean, if you're manufacturing, that gets really in the weeds and I think it takes an accountant. But I don't really have any resources again. The important thing is that where I see a lot of mistakes is your inventory is calculated based on your cost. You're not trying to assume the value of it. Your cost is what matters there. So that is a good thing to know.
And as
Um,
far as for SCORE, I don't think we get that specific. What we'll do is most of our webinars will be probably geared to the widest possible audience, to be of the greatest value to the greatest across the greatest spectrum. And one of the things that you'll see coming up here, I would heartily recommend you get on score.org, even get Google Score Central Maine, and you'll see templates, workshops, and mentors. You can not only request a mentor from that website, but you can also see what kind of other workshops that we currently have in the works and choose the ones that may be the best for you. Now, Cinnamon Brulee sells artwork, created a limited series artwork with a portion of sales going towards Maine Charitable Foundation's recovery fund. How do I navigate this in QuickBooks?
well,
So,
in terms of charitable donations, you know, depending, those are usually appraised at some level to determine the value for your books or for your deduction. Not, you know, most charitable organizations will give you documentation of your giving, which for me, not that I'm super familiar with your particular scenario, but for me at tax time, that's kind of my guide on how to that treatment.
I see. And we have the QuickBooks class that we're putting on, a free QuickBooks webinar. I believe it's in the evening of the 6th of March, but don't take my word for it. Get on our Central Maine Score .org website and you'll be able to see that and other workshops that we offer as well. Then we have from Amy Smith, can you deduct mileage from client to home or only home to client and client to client?
Yeah, I think, client to home is a deduction for sure. It's just, but I encourage you if you are doing a lot of travel or if that's your primary business to, kind of research that. But yeah, that would be a good argument for a mileage deduction because you're not going to like I'm going a few miles between work and office, like just as if I had a job. So that's not something I would, like I said in the seminar, deduct.
Understand. And then our final question for asking for a friend again is to claim the home office deduction. Does the office have to be in a separate room or can it be set up in a larger room that's also used for personal use?
Yeah, that's a great area for sure. You'd want to see it partitioned or some sort of something distinguishing the office space, because it's like the first line when you look at any guidance is exclusive use. So that's a really, you really wanna define that exclusive use, in my
Right.
opinion. Mhm.
And although we're all done with our Q&A, I just wanted to mention we've got a number of comments saying thanks, fantastic webinar, would love to see it again, etc. So thank you, Echo. Really appreciate it. Is there anything that you'd like to say before we go ahead and close out?
No, I just, I know last time we said that if there was any follow-up questions that you didn't think of, perhaps they could get to me somehow, in another, forum or an email. So I'd like to offer that, as well.
Great. Thank you very much. Now, I wanted to thank everybody for attending, and we'll send you a copy of the slides, as I said before. We'll also be loading this workshop on our Score Maine YouTube channel. We've just instituted that in the past couple months, but you'll be able to access this and other workshops on our YouTube channel. And we'll also be sending you a brief online survey from Score about the event. We appreciate your feedback. It helps us improve. It's up to you whether or not you'd like to complete this or not, but we would really appreciate it. And as a reminder, wanted to let you know that Score Maine offers free, confidential, one-on-one mentoring, whether you're starting or growing your business. It's very easy to request a meeting with a mentor by visiting score.org and just filling out a brief online form. And we'll try and match you with the mentor who's probably going to be able to help you the best. SCORE is a nonprofit partner of the SBA, and we have over 300 chapters across the United States. And with three right here in Maine, we've helped over 11 million entrepreneurs since 1964, and we have over 10,000 mentors who are participating, all volunteers in this effort. We hope to see you again at one of our future events. Now, really appreciate it, Echo, and good working with you again. Thank
Thank
you.
you. All
All
right.
right.
Have a great day. All right. Bye-bye.